What are futures? Futures contracts are agreements to buy or sell assets at a future date and an agreed upon price. So in its simplest terms, what does all this mean and what is the purpose of a futures contract? Let's use a basic and easy to understand example that I've always liked. Say it's Christmas time and you want to buy a Christmas tree. The place you usually buy your Christmas tree every year has no trees left because the demand was too high. To better prepare for next year's Christmas, you decide to sign a contract that you'll buy a tree on the first day of December. The contract guarantees that you'll have a tree available to you on the 1st of December as long as you make the agreed upon payment on the contract. Christmas is starting to get closer and closer and you're starting to realize there may be more than enough trees this year than there was last year. This possible surplus of trees makes you wonder about the value of your agreed contract. Are you ultimately going to end up paying too high of a premium to pre-order this Christmas tree? So instead, after thinking further on it, you decide it wasn't a great idea after all to promise such an excessive amount for a Christmas tree. So you decide to sell your contract to someone who isn't as optimistic about the tree supply as you are. And this is exactly what futures trading is like. You're trading a contract. You either believe in its value or you think it's overvalued. But in the world of technical trading, there are numerous day traders or swing traders that don't care about Christmas trees and are simply making money off the speculation of the contract's value. They're buying and selling contracts every day, week, or month before Christmas even occurs. I hope that example made sense. You can buy and sell these futures contracts over exchanges and they'll always be available just based on the liquidity in the markets. But let's move on. Let's talk about how futures trading is different from stocks and options and why it's more beneficial. With stocks, you're obviously taking partial ownership of a company, whereas with futures, you're entering into a legal agreement to buy or sell an asset at a specified date and time as discussed earlier. But the benefits of trading futures over stocks is that they have significantly better tax advantages. If you're day trading stocks or swing trading them for less than a year, you're taxed at 100% short-term capital gains, meaning you pay more. If you're day trading futures, you're taxed at 60% long-term capital gains, meaning you pay nothing or significantly less, and only 40% short-term capital gains. So that definitely makes a big difference come tax time. Additionally, you have to scan for different stocks every day to see which one is in play to maximize your trades. With futures, you trade the same markets every day and therefore you eventually get used to how the price action works. And unlike stocks, with futures, you can manage your positions overnight and can trade almost 24 hours throughout the day without having any kind of liquidity problems. As far as the difference between futures and options, again, with futures, the contract states that you have an obligation as the buyer to buy or sell an asset in the future at a specific price. But with options, you have the right, but not the obligation, to buy or sell an asset in the future at a specific price. But why might futures still be more beneficial than options? Well, for one, in my opinion, futures are simpler. There's no theta or Greeks you have to worry about. Again, with futures, you have better tax benefits than you do with options. The ability to trade in the overnight markets and better liquidity also gives futures an advantage over options. So what time of the day specifically can you trade futures? First things first, each product has its own unique trading hours, but for the most part, futures are traded from 6 p.m. Eastern Time to 5 p.m. Eastern Time the next day. Then the market closes for an hour, and this schedule is from Sunday through Friday. Saturday, the markets are completely closed. Again, these hours apply to most futures like the stock indexes, metals, energy, currency, crypto, and interest rates. However, when it comes to agriculture like corn, soybean, wheat, which aren't as popular as the others, they trade from 8 p.m. Eastern Time to 8:45 a.m. Eastern Time the next day. Then there's a 45-minute break from 8:45 a.m. to 9:30 a.m. and then trading starts again from 9:30 a.m. to 2:20 p.m. Eastern Time. And again, it closes from 2:20 p.m. to 8 p.m. This schedule runs from Sunday through Friday, and Saturday, like the other futures contracts, agriculture market is completely closed. The most trading activity for futures occurs Monday through Friday between 9:30 a.m. to 4 p.m. because that's when the stock market is also open. As far as other global markets, the Asian markets open at 9 p.m. Eastern Time, so you'll see activity pick up around then. The European markets, like the London Exchange, open up at 3 a.m. Eastern Time, so very flexible hours all around to accommodate different traders to different kind of instruments, depending on which global market you're trading. So you can be someone who's nocturnal or an early bird. There's always something available to trade when it comes to futures. So here's a chart of the most popular futures that are traded in the markets. There's a few that I left out from the interest rates and crypto sector, but for the purposes of getting the chart to fit, here are the major ones. So this column right here represents the name of the futures contract. The next column represents the type of futures that contract is. These are the symbols associated with those futures, and you would enter these symbols into whatever broker software you're using to trade. The next column represents the tick size for each of these futures, meaning these are the increments that they move in on the trading chart, which brings us to the column for tick value. The tick value is the amount you'd be making or losing if the trade is going against you based on each tick size. So using the S&P 500 for example, you'd make $12.50 every time it moves up 0.25 ticks if you're going long or moves down 0.25 ticks if you're going short. The last column represents how many points would be needed for you to make $200. I just picked $200 because if you average that amount every day for all the trading days available for the year, that would amount you to around $50,000, which would basically be equivalent to a standard full-time salary. So basically the S&P 500 index would need to move 4 points for you to make $200 based on its tick size and tick value that we talked about in the previous columns. And here are the rest of the points as well needed for $200 for their respective futures based on the tick size and value. Now let's talk about micros. So micros futures basically work the same as your regular futures. The only difference is that they're basically 1/10 of the size, and most of them also have an M in front of the symbol. The reason why micros are available is because some people can't afford the initial margin that is required to trade your regular futures or E-mini contracts, so they opt to micro contracts instead to build their small account. Another reason may be because micros allow traders to buy significantly more contracts than if they were to buy regular E-mini contracts. So instead of buying one ES contract, they decide to buy 10 micro ES contracts, which would be the same value. And the reason why they would do this is because they can scale out, meaning they can sell a third at one price target, a third at another price target, and the last third at their final price target. Whereas a regular E-mini contract would limit you to buy and sell at one price target if you're only buying one contract. But keep in mind too, you may end up paying more commissions buying multiple micro contracts than you would just buying one regular E-mini contract, depending on the broker you're with. So those are the differences between your micro and mini contracts. Let's move on. Let's talk about the news events associated with futures trading. I use this website called forexfactory.com, and once I'm on that website, I go to the calendar section. Before I'm even trading futures, I am looking at this calendar both daily and weekly so that I'm informed what events are coming up that could possibly drive the movement of a futures contract. As indicated by this image, the folders highlighted in red represents an extremely important news event such as unemployment numbers, GDP, CPI, FOMC, core retail sales. The results of these events, which are released at the date and time indicated on the calendar, have huge implications on the volatility of that said futures contract, meaning once those results are released, you're going to see some significant spikes, whether it's up or down in the futures market. So if the red folder is associated with the USD currency, it's going to affect things like the US indexes such as the S&P 500, NASDAQ, etc. If the currency is JPY for instance, then it'll have an effect on the Japanese yen futures contract, and so on and so forth. The orange folder represents a very important news event, but not as important as the red folder, and the yellow folders represent the least importance impact out of the three colored folders on the futures market. So you always want to be aware of what events are coming out for the day, for the week, because they will play a huge factor into your trades. So you can break down a futures trader, or any trader for that matter, as a fundamental trader or technical trader. Fundamental traders trade futures based on its intrinsic value. Technical traders focus on a future's price and volume. Fundamental traders are primarily focused on economic conditions and the industry outlook. Technical traders are focused on the futures chart and look for support, resistance, and trend lines on that chart to determine where that futures instrument is moving next. Most futures traders are technical traders. They use indicators and tools to validate and confirm why they think that specific futures will move where it'll move. And they do this by looking at the candlesticks. So here you see a red candlestick which indicates bearish sentiment and a green candlestick which indicates bullish sentiment. There are various ways to study candlestick patterns, and honestly it would require its own video, but for the purpose of this video, we're simply going to talk about the basics and what they mean. So you have your two basic candlesticks, and we'll start with the red one first. So every candlestick has its high, low, open, and close. Sometimes they overlap, and a close could be its low, or an open could be its high, or all four could be completely different price points. But with this specific candlestick, and honestly most of the candlesticks for that matter, there are four separate price points. This line right here is called the wick, and the beginning of this body is called the open, meaning this is the price the candlestick opened at. It went further up and got marked at this high before bears pushed it back down. It went all the way down to this low right here before the candlestick ultimately closed bearish just above that low, ultimately forming this wick. So this part of the candlestick is called the body. The body is the part between the open and the close, and the highs and lows outside the body are represented by the wicks. So the fact we opened high and closed low means we formed a red bearish candle. The opposite is true for the green bullish candle. We opened low and closed high. This means price action is going up. The body represents the price movement between the open and the close, and the wicks represent the highs and lows of the prices this candlestick touched. Technical traders focus on an accumulation of these candlesticks on the chart to see which price point they may be bouncing off of, or which price point they may be getting rejected from. This eventually forms trends and patterns that technical traders can see, and they use this analysis to look for opportunities to buy or sell on the chart. Again, the heavy focus is on price movement, and identifying accurate predictions with these price movements comes with practice. Let's take a deeper look on the technical analysis side of things. Once you master that aspect of trading, there's nothing stopping you from trading futures successfully. The bid and the ask, or in other words, the supply and demand, drives the direction of a futures chart. When you have the time, please watch a very visual friendly and detailed video I made explaining supply and demand for beginners and how it correlates to support and resistance zones. But basically, the bid price for a futures contract is what the buyer is willing to pay for the agreement, and the ask price is what the seller is willing to sell the agreement for. A support and resistance zone are price levels in which price action struggles to break through. So typically, traders buy at support or short at resistance. But when the charts eventually do break through support and resistance, volume increases and traders step in to further move the futures chart up if it breaks resistance, or further move the futures chart down if it breaks support. Traders also look at multiple time frames when making their analysis. Typically, they want to see a whole picture of a specific futures instrument to determine if they're going to go long or short. So they'll extend the chart out for the day, the week, the month, and even a year. They extend it out that far to map out significant support and resistance levels on the chart as well as trend lines. They then transition to a shorter time frame like the 5, 10, or 15 minute candlesticks to place their trades at an exact precision point of their liking. But that basically breaks down the technical analysis trading side of things. If you guys are interested in starting futures, I recommend finding and perfecting a really good strategy. There's tons of YouTube videos out there for free that have very reliable results with a good risk to reward ratio. I have a few strategies of my own that you guys can check out by just browsing some of my videos in my channel. But whatever you end up choosing and are comfortable with, please practice, practice, practice. I can't emphasize that enough. There's a lot of brokers out there that provide their own trading platform for free, and they each offer a simulation version of that software. I personally use Thinkorswim, which is provided by TD Ameritrade, soon to be Schwab. And I wouldn't start trading with real money until I see consistent results for at least a solid 3 months. But when you are ready to start trading futures, I would highly recommend a prop firm. A prop firm is a company that provides capital to its traders so that you don't have to risk your own. I personally use Apex Trader Funding because they offer the highest discounts for their evaluations. Right now they have an 80% discount code going on at the time of this video. So if you guys found any value in this video and wanted to purchase an evaluation, please consider clicking the link down below. It helps out my channel, but you don't have to, and I really appreciate the time you took to watch this regardless. I hope you guys learned a thing or two on futures trading. If you have any questions, please ask in the comments down below. Good luck in the markets, and I hope all of you have a great day. Peace.